Debt has been called the silent predator of nations, quietly growing until it devours the stability of entire economies. Throughout history, countries that borrowed heavily in good times often found themselves trapped in spirals of inflation, default, and political unrest. In ancient Mesopotamia, kings would issue loans to farmers and merchants, promising repayment with future harvests. Yet repeated crop failures led to mass debt forgiveness and economic disruption. These early examples reveal that even civilizations thousands of years ago struggled to manage the balance between borrowing and solvency. The paradox is striking. Borrowing fuels growth, yet excessive debt sows the seeds of collapse. Modern economies are no different, with countries expanding credit while ignoring the slow accumulation of hidden liabilities. Greece's national debt crisis of 2010 shocked the world, yet it followed patterns seen in earlier defaults in Argentina and the Weimar Republic. High borrowing allowed governments to finance deficits and social programs temporarily, but it created long-term fiscal fragility. Japan, the world's third largest economy, has carried debt exceeding 160% of GDP for decades, yet markets tolerate it because of government bond ownership and low interest rates. This paradox raises the question, how long can such debt be sustained before markets demand accountability? Even the United States, long considered the safe haven of global finance, faces rising debt exceeding $33 trillion with unfunded liabilities growing quietly in the background. The more the debt grows, the closer the nation edges toward financial tipping points, unseen by the casual observer. Debt accumulation is not a gradual threat. It compounds exponentially, creating pressure that eventually bursts through political and economic structures. Each borrowing cycle leaves nations more vulnerable to shocks, whether from a banking collapse, geopolitical tension, or currency crisis. The story of sovereign debt is also a story of human behavior. Governments, investors, and citizens consistently overestimate short-term growth while underestimating long-term risk. This creates a recurring pattern where the promise of prosperity blinds societies to impending collapse. History offers numerous warnings. In 1923, Germany's hyperinflation turned savings into worthless paper within months, erasing wealth and destabilizing the economy. That event, though nearly a century old, mirrors dynamics seen in modern debt crises where monetary expansion and borrowing collide destructively. The essential question emerges: why do nations repeat these mistakes, even when history provides clear lessons? The answer lies in the seductive illusion of growth, fueled by borrowed money, a pattern that continues to shape the modern world. Debt rarely becomes dangerous overnight. It accumulates through predictable cycles of borrowing, spending, and currency expansion. Nations often rely on debt to stimulate growth during downturns, but repeated borrowing creates hidden structural vulnerabilities that compound over time. Sovereign debt functions like a chain reaction. Governments issue bonds to fund deficits. Banks buy those bonds, and central banks intervene to maintain interest rates. This interplay creates an illusion of stability while slowly increasing exposure to economic shocks. Credit expansion amplifies the problem by lowering borrowing costs and encouraging risk-taking among governments, businesses, and consumers alike. As debt grows faster than GDP, the capacity to service it diminishes, creating latent pressure that can explode during a financial shock. Interest payments on mounting debt eventually consume an increasing portion of government budgets, leaving less room for essential spending on infrastructure, healthcare, and social programs. When markets sense rising risk, borrowing costs rise, making the debt burden even heavier. Currency value is another critical component in the debt spiral, as borrowing in foreign currencies exposes countries to exchange rate shocks. A sudden devaluation increases debt in domestic terms, magnifying the financial strain and forcing governments into austerity or default. Central banks often attempt to manage the spiral by printing money or buying government bonds, a practice known as quantitative easing. While it temporarily stabilizes markets, it inflates the money supply, pushing inflation higher and eroding public confidence in currency value. Historical patterns show that debt crises are rarely isolated events. They ripple across economies through trade, banking, and financial markets. Contagion spreads when investors withdraw capital, interest rates rise globally, or currencies depreciate, creating systemic risk even for nations with sound fiscal policies. Sovereign debt cycles resemble a Ponzi scheme in structure. As long as new borrowing continues and investors are confident, the system appears sustainable. The moment confidence falters, defaults and banking crises cascade, revealing the fragility hidden beneath layers of financial engineering. Debt-driven inflation is both a symptom and a cause of economic instability. As governments print money to service obligations, prices rise, savings are destroyed, and citizens demand higher wages, creating a feedback loop that fuels further instability. Even disciplined monetary policy cannot entirely prevent the pattern, because the underlying driver is human behavior, overconfidence, optimism bias, and short-term political incentives. This is why nations with vastly different institutions and cultures still fall into remarkably similar debt crises. Greece's debt crisis, which began in 2010, revealed the fragility of excessive borrowing in the Eurozone. By that year, Greece's debt-to-GDP ratio had reached nearly 146%, forcing the government to seek a $110 billion bailout from the IMF and EU. The bailout required harsh austerity measures, including tax hikes and spending cuts, which plunged the economy into a deep recession. Unemployment soared above 25%, and GDP contracted by nearly 25% over 5 years, creating a social and political crisis alongside the financial one. Interest rates on Greek government bonds skyrocketed as investors feared default, with 10-year yields briefly exceeding 35%. The country faced a vicious cycle. High debt triggered higher borrowing costs, which worsened the debt burden and fueled investor panic. Argentina provides another stark example of sovereign debt failure, culminating in the 2001 default. The country had pegged its currency to the US dollar in 1991, which initially stabilized inflation but created rigidity when external shocks hit. By 2001, Argentina's debt exceeded $132 billion, nearly 50% of GDP, and the government was unable to service its obligations. The currency peg collapsed, inflation spiked, and the economy contracted by 10% in a single year, demonstrating the danger of rigid monetary policies in a debt-laden system. Weimar Germany in the 1920s exemplifies hyperinflation caused by excessive monetary expansion to finance reparations. By 1923, the market lost nearly all value, with prices doubling every few days, destroying savings and collapsing the domestic economy. The German government's solution to reparations and domestic debt was relentless printing of money, which created a runaway inflation spiral. Citizens carried wheelbarrows of cash to buy basic goods, illustrating how debt mismanagement can destroy public confidence in currency. In all three cases, banking systems suffered severe stress as defaults and currency collapses triggered widespread financial losses. Banks that had lent to governments faced insolvency, while ordinary depositors lost wealth, amplifying the social and political consequences of debt mismanagement. Each historical crisis demonstrates a recurring pattern: debt accumulation, rising interest costs, inflationary or currency pressure, and eventual economic collapse. Despite differences in geography and era, the sequence of fiscal mismanagement and monetary response is remarkably consistent. These case studies underscore the warning embedded in history. Borrowing without structural reform is a slow-motion disaster. Nations may temporarily mask risk, but without corrective policy, the debt spiral inevitably accelerates toward crisis. The United States carries the largest national debt in history, exceeding $33 trillion as of 2026, with annual deficits above $1.5 trillion. Despite this, low interest rates and global demand for treasury bonds have allowed the government to continue borrowing without immediate crisis. Japan has sustained debt exceeding 260% of GDP for decades, yet low interest rates and domestic government bond ownership have prevented collapse. Still, demographic decline and persistent deflation create structural vulnerabilities that could trigger a future fiscal shock. Eurozone nations, including Italy, Spain, and France, face mounting debt pressures, often masked by the stability of the euro. When economic growth slows or interest rates rise, these countries could experience borrowing costs that make debt servicing unsustainable, echoing patterns seen in Greece. China, while appearing financially robust, carries massive local government and corporate debt, exceeding 300% of GDP when combined. Shadow banking and off-balance sheet borrowing amplify the risk of localized defaults, spreading through the domestic financial system. Emerging markets are particularly vulnerable to dollar-denominated debt, as rising U.S. interest rates increase repayment costs. Argentina and Turkey, for instance, have faced currency devaluations and inflation surges due to external borrowing, demonstrating the global reach of sovereign debt risk. Central banks globally have flooded markets with liquidity through quantitative easing and asset purchases since the 2008 financial crisis. While these measures temporarily stabilize financial systems, they also expand balance sheets and encourage higher risk-taking, mirroring historical precursors to debt crises. Low interest rates have created a moral hazard for governments and investors alike, encouraging the belief that debt can expand indefinitely without consequence. Yet, rising inflation and tightening monetary policy in 2023-2025 show that markets may no longer provide unlimited patience. Corporate debt, intertwined with sovereign obligations, adds another layer of fragility to modern economies. Highly leveraged corporations may default if interest rates rise or economic growth slows, transmitting risk back to banks and government balance sheets. The global debt-to-GDP ratio now exceeds 350%, a historic high, signaling unprecedented leverage across public and private sectors. This level of indebtedness leaves countries vulnerable to shocks, whether from geopolitical conflicts, trade disruptions, or sudden changes in investor sentiment. Even in economies considered safe havens like the US and Japan, the structural pattern of borrowing, monetary intervention, and debt accumulation mirrors historical crises. The difference today is scale. The global system is far more interconnected, meaning a debt shock in one region could propagate worldwide. If current debt trends continue, sovereign defaults could rise, forcing governments to restructure obligations or impose harsh austerity measures. Such events would mirror historical crises, creating widespread economic contraction and social unrest. Currency devaluation becomes a likely outcome as nations attempt to reduce debt burdens in real terms. This erodes purchasing power, triggers inflation, and diminishes savings, creating ripple effects across households and businesses. Central banks may face impossible choices between tightening policy to control inflation or maintaining liquidity to prevent defaults. Either scenario risks destabilizing markets as interest rates rise, bond yields spike, and investor confidence falters. Banking systems remain highly vulnerable as defaults on government debt threaten commercial banks' solvency. A collapse in confidence could freeze credit markets, amplifying economic downturns and disrupting trade and investment flows globally. Inflationary pressures could accelerate as governments monetize debt to avoid immediate default. Citizens would face rising living costs, creating political pressure and social unrest reminiscent of Weimar Germany's hyperinflation period. Global interconnectedness ensures that crises in one country or region spread rapidly through trade, banking, and investment channels. Emerging markets, heavily reliant on foreign capital, could experience severe financial stress, even if their domestic debt remains moderate. Investor behavior may further exacerbate instability as risk aversion leads to capital flight and currency volatility. Sovereign bonds would come under intense scrutiny, with rising yields, increasing borrowing costs, and deepening debt spirals. Commodity markets could experience sudden shocks as countries attempt to secure essential imports or exports under currency stress. These disruptions would disproportionately affect nations reliant on energy, food, or raw materials, compounding economic hardship. Social and political consequences are unavoidable when debt crises persist, with mass unemployment, protests, and rising inequality. Governments may face crises of legitimacy, limiting their ability to enact effective reforms and prolonging economic stagnation. Ultimately, the global economy risks entering a period of slow-motion instability where repeated shocks accumulate, creating long-term structural damage. Historical patterns suggest that without proactive intervention, the next decade could see multiple debt crises unfold in rapid succession. Debt crises are inevitable in every era, yet nations can temporarily delay their consequences through policy choices and structural interventions. History shows that countries with disciplined fiscal management and strong institutions recover faster, even after severe defaults. Reserve currency status provides countries with temporary relief, allowing them to borrow at lower interest rates and maintain confidence. However, it does not eliminate the underlying risk of debt accumulation, as seen in the United States and Japan. Paradoxically, the very mechanisms that stabilize economies, central bank interventions, quantitative easing, and fiscal stimulus, can also sow the seeds of future crises. These tools mask risk while allowing debt to grow unchecked, creating a fragile system that depends on continuous confidence. The contrarian insight is that no country is immune, regardless of size, wealth, or political power. Even the most robust economies eventually face the structural pressures of accumulated debt, revealing vulnerabilities long before they become obvious. Debt spirals are not random accidents, but predictable cycles driven by human behavior, policy choices, and systemic incentives. Recognizing these patterns allows policymakers, investors, and citizens to understand risk, even if avoiding it entirely remains difficult. Historical collapses like Weimar Germany, Argentina, and Greece provide clear warnings, yet each generation repeats the same mistakes under different circumstances. This cycle demonstrates that awareness alone does not prevent the inevitable, only postpones it. Modern economies can buy time through monetary and fiscal tools, but the underlying dynamics of debt accumulation remain unchanged. Eventually, either a crisis or structural adjustment becomes unavoidable, leaving little room for error. The key lesson is that short-term growth funded by debt is seductive but dangerous, and long-term stability requires structural reform and fiscal discipline. Without these measures, history suggests that the next generation of debt crises could surpass anything previously experienced. Understanding debt spirals reframes how we view modern economics. Crises are not anomalies, but natural consequences of financial systems pushed to their limits. This perspective challenges conventional narratives of perpetual growth and invites a sober evaluation of national policies. In conclusion, while debt enables growth and prosperity temporarily, it is also a hidden force shaping economies and societies for decades. Recognizing the pattern is the first step in mitigating its most destructive effects, even if complete prevention remains elusive.